Good morning, everyone. Today is our second revisionary session on foreign exchange and risk management. Yesterday, in our session, we completed the concepts of we had discussed the concepts of what are the types of transactions involving foreign currency, what are the steps in computing ROI from investment in foreign currency. Then we discussed what are the different types of quotes, direct quote, indirect quote, American term, European term. Remember, India generally expresses foreign exchange following European term, wherein we basically identify the foreign currency in that is USD in the denominator, right? And we write our rupee currency in the numerator. Further, we discussed what are two-way quotes. So bid rate and ask rate. Bid rate is the rate at which bank buys the currency, which means that is the rate at which a customer sells. And that is the reason we say bid rate is sell rate, because for customer, it is a sell rate. Ask rate is buy rate. We further discussed how to essentially convert our rates from direct into indirect, the two-way quotes from direct quote into indirect quote, cross rate currency, how we cover rate, spot rate and forward rate, arbitrage, and net exposure of each foreign currency. Now, today we are going to discuss essentially what are the different ways of hedging our currency risk. Yesterday, we had very briefly touched upon that particular aspect, right? Now, today we will be discussing what are those different techniques available, and we will obviously be solving some questions on the same as well, right? So these were the various techniques which are available to us, which we will be discussing today one by one. All right. Now, let us start. So what are the different techniques of hedging currency risk? So what are the different techniques of hedging currency risk? Now, normally, we never discuss about the first option, because this is actually not an option of managing or hedging currency risk, but nonetheless, it is one of the options available to the investor, and that is no hedging. What do you mean by no hedging? You take the situation as it is. Whatever happens, I will deal with it at that particular moment. I am not going to do anything. Let the market play its role. I am not going to intervene. I am not going to try to hedge my currency risk. Whatever happens will happen. So as a result of that, there is an option. Of course, it is not a technique of hedging a currency risk, but nonetheless, it is an option available to the investor. If he doesn't want to do anything, then obviously he won't, right? So this, strictly speaking, is not a technique of hedging currency risk, but it is one of the options available to the investor, right? Next is invoicing. Invoicing your customer in domestic currency, meaning in our currency. So say, for example, if I am essentially doing a business with a party in US, instead of expressing my exchange in dollars, I am going to essentially invoice him in rupees. By doing this, what I do is I shift the complete risk of foreign currency, shifting the risk onto my customer. Onto my customer. Right? Now, in the short while, it may be a good way to go about it. Because as far as I am concerned, now I don't have to worry about whatever is the risk on hedging currency risk. But in the long term, if managing the currency, different foreign currencies, etc., is a hassle to your customer, then your customer might essentially try to find a different supplier who will take care of that particular risk rather than shifting that risk onto you. So while this strategy or this approach definitely allows you to manage your or hedge your currency risk, it definitely creates a future risk for your business per se altogether, because maybe if managing a foreign currency is a hassle, then in that case, your customer might move away to somebody else who is going to take that trouble for him, right? So in generally in perfect competition or in a very competitive markets, you will find some or the other supplier will essentially turn up who will say, okay, I will take care of this. And in that case, your business may end up losing a customer. So it becomes a foreign exchange risk may turn up into a business risk per se, because you might lose a customer. But nonetheless, in the short term, this can definitely be a way of hedging your currency risk. Next is leading and lagging. Leading and lagging. What do you mean by leading? So in the money market situation over here, or your commitments which are there towards your suppliers, if you end up paying prior to the maturity, it's called leading. So leading is nothing but making your payments before maturity. Making your payments before maturity of the instrument or before maturity of your liability. Lagging, on the other hand, is obviously, as you must have guessed, payments after maturity, right? Now, why would any particular entity take either of these approaches? Payments after maturity, definitely I'll get the benefit, but then nobody is going to give me free benefit after maturity, right? I will have to pay the cost for it. So why would a businessman essentially take the option of leading or lagging? So let us understand this in a way. Say, for example, if I am a debtor, right? If I am a debtor, that means the other party is a creditor. So I have in my books payables, right? I have to make payments. I have payables in my books. Now let us understand. If what happens to the foreign currency vis-a-vis your local currency, and as a result, how does it actually have an impact on the approach I will use between leading and lagging, right? So I am a debtor. Right now, I have in my book payables, right? So say, for example, if foreign currency is appreciating, is expected to appreciate, meaning today, say, for example, $1 is equal to rupees 65, and it is expected that $1 will become rupees 66, for example. Considering I have a liability to pay, my obligation will increase, right? Foreign currency is appreciating, which means my local currency rupee is depreciating. So which is a better approach for me, to pay early or to delay the payment? If I pay today, I will have to pay only 65. If I pay after, say, for example, 1 month, when the rates would have changed, when my obligation is actually due on the maturity date, then in that case, I will pay 66. So as a result of that, my approach over here will essentially be, I will want to pay today. What is the underlying principle? My outflow will be lesser, right? Say, for example, in the same place, if we take the opposite scenario, where foreign currency is depreciating, local currency in that case obviously means appreciating, right? In that case, what will be the approach? So say, for example, today it is $1 is 66, and 1 month later it is expected to become $1 is equal to rupees 65. Then in that case, it is beneficial for me to delay my payments, because thereby I will essentially save 1 rupee per dollar, right? So then the approach will be lagging. Similarly, now, say for example, if I am a creditor, that means I have in my book receivables. Will my process, will my approach change in that case, in the same scenario or a similar scenario? Now, let us consider, if I have receivables in my book, then what will happen? Now, say for example, again we take the same scenario. If foreign currency is appreciating, local currency is depreciating. Now remember, I have a receivable. Okay, foreign currency is expected to appreciate. So $1, which is 65 today, will become $1 is equal to 66 by the due date. So in that case, as a creditor, what is beneficial to me? If the amount will be paid on maturity or later, right? So here I will essentially be happy with lagging, right? Because then my outflow as a creditor will be higher. On the other end, if it is foreign currency is depreciating and local currency is appreciating, then in that case, remember, local currency appreciating, it will be the reverse case, right? Meaning today $1 is rupees 66. It is expected to become $1 equal to rupees 65. So I will get lesser money if it is paid at due date. In that case, I would prefer the leading option, right? This is basically the approach of leading and lagging, why essentially a businessman or a party to foreign exchange transaction would opt for leading or lagging. We had solved one sum on this particular topic yesterday also, where we were comparing whether we should pay it after 60 days or after 90 days, right? We had done question number 2 yesterday, if you recall. We had done question number 2, where we had compared.
Yes.
This was question number 3. We had done question number 2.
60 days and 90 days.
Yeah. So I think we had done that, right? Yeah, this one. So this is the question which is on leading and lagging, right? All right. So 3 approaches. First, no hedging. Remember, this is strictly speaking not hedging at all, right? No hedging. It is just an option available, but it is not a technique of hedging currency risk. It's basically no technique per se. However, yes, it is an option available to the investor if he doesn't want to hedge any currency risk. Second is invoicing in domestic currency. Third is leading and lagging. We go now to the fourth option. What is the fourth option which is available? Fourth option is netting, and I'm going to take along with it money market hedge, right? So how does this work? Netting. Now say for example, I have a receivable of $10,000. On which date? On 31st March 2025, right? And I have a payable again of $10,000, which is again happens to be on 31st March 2025. Then in that case, rather than receiving this $10,000, bringing it into India, converting it, thereby incurring the cost of conversion, bearing the risk, what I would do is I would essentially reach out to my my customer basically, and I would say, please pay to so and so person, right? I will give him the bank account details and I will ask him transfer the payment not to me, but rather to my supplier, right? As a result of that, $10,000 will be paid out directly to my supplier, and I don't have to worry about the foreign exchange risk in that case. However, practically speaking, can this happen on a regular basis? If it is happening on 31st March, it is pure coincidence. Your supplier is not going to reach out to you and your customer is not going to reach out to you, identifying first of all, okay, what is the due date you want? Let us match it. You can't do business that way. So that means what happens, say for example, if I have a receivable, which is going to happen, let's say on 31st of September instead of 31st of March, then what happens? Yes, how do I essentially bridge the gap in that case? Because then it is going to be for a period of 6 months where I actually have to pay my liability 6 months before 31st March, and say for example, my asset is actually falling due on 30th September. 6 months gap in between. Then how do I bridge this particular gap? Then in that case, to make this coincidence of netting, which we had earlier, same dates, that coincidence can essentially be arisen or given rise to by using a money market hedge. Money market hedge. So how would a money market hedge work? Since I have a payable on 31st March, right? I need to have a receivable on 31st March. So how would I do that? How can I do that? How do I bridge this particular gap? So try and understand, on 31st March 2025, I need a payable over there, right? I have a payable over here, which means I need an asset over here so that I can pay off this particular liability. Similarly, on 30th 9, 2025, I am going to have a receivable, which is an asset, right? Which I want to set it off against. So here I will need a liability, which I can pay off, because here I have a receivable. Now let me put values over here. Say for example, the value over here as we have is $10,000. So I have $10,000 to be paid over here. Okay. So how do I essentially address that? I don't have any money available to me right now. So what
Borrow
do I do?
the money.
Very good.
Borrow.
Yes. So I will borrow the money, $10,000. Okay. As a result of that, what does that do? I will be able to use this money to pay off this liability. Now, this borrowing will have to be paid, right? So when is it going to be paid? I'm going to pay that on 30th September 2025. So when I receive this money, I will use that money to pay this off. Are you with me? Now, in this example, as of now, we have not considered the cost of borrowing, because it sounds very good. Borrow the money and then you can pay it off. But there is no business which is going to happen, no borrowing which is going to happen for free. You'll have to pay the cost of it. Say, for example, I have to pay over here 10% interest, right, per annum. So that means 6 months later, I will have to pay how much? $10,500.
500.
Right? Now, strictly speaking, over here, what I will do is I will try to adjust or take the loan to the extent of the asset which is there. Because here you can see now my asset is not matching. So I still end up having $500 more. So what I generally do is, this is 10,000 over here. My asset is 10,000. So I would want to have liability of 10,000, which means the borrowing which I will do over here will be to the extent of 10,000 divided by 1.05. What is this 5? Including the interest. Right? Because 5% is interest for me for 6 months, right? Now you might say, sir, this is obviously going to have a mismatch over here of $300, $400. That mismatch over here, I can address it right now in the spot rates and address this particular liability. Are you all with me? As a result of that, I don't have to carry forward any liability further. My money market hedge allows me that opportunity to create this hedge. Right? So, if you have the same due dates available where the receivable and payable matches, then I don't have to worry. I can just do the netting. I can ask my customer, please don't pay me, pay the supplier. However, where the dates don't match, I create a money market hedge. I either borrow or I invest. If I have to pay the money, that means I would need to create an asset, right? On the other hand, if I have to receive the money, I will create a liability, right?
Sir.
Yes.
So in practical, particularly in current scenario, when there is, market is volatile in any respect, share market or foreign exchange market or money market, in current scenario, war and all these things, how far these school of thoughts, are workable? Is proved useful.
In fact, these techniques become even more so important in these times compared to earlier. So I'll give you one example of one of my client. They are an export-oriented unit. And earlier they used to have this strategy where 50% of their receivables, because it's a 100% export-oriented unit. So you can imagine all their receivables are in foreign currency, right? Dollars, euros, JPY, etc. Now, they used to have the strategy that 50% of whatever is the receivable, that we will buy a forward so that we have some exposure available. At the same time, for the 50%, they used to keep an open exposure that if the market improves in our favor, right, then we can take a benefit subsequently. So say, for example, today I do a transaction of $10,000 where they have a receivable of $10,000. On the same day, they would take a forward cover of $5,000, which is 50%. The balance 5,000, they used to keep it open-ended. But in today's time, they are not practicing that. They are taking 100% cover. And the reason for that is simple, because the money market, or rather I should say the forex market per se, because of the international things, have become very, very volatile. I don't know how much have you observed, but if you see the day when Donald Trump essentially said that, okay, my tariffs are going to play a role, it's going to come into effect, and immediately the markets were essentially trembling, right? Your equity markets essentially suffered a great deal. Even forex markets had a huge address to it. Even oil prices had a huge impact on it. So that definitely has an impact on your obligations as well. No doubt. A day later, he said, okay, I'm going to defer it by 90 days and whatnot. And then again, market started reversing their position and stabilizing. But that essentially gives very, very volatility. It brings your volatility within the range which you can manage, right? The idea of hedging is basically you keep your obligations within the limit which you want so that you are able to manage the risk. Have I answered your question, sir?
Yes, sir. But sir, why other party will be ready in particular this scenario? Because there must be two party, more than one party.
Yes.
So why the opposite party will be ready to buy the forwards? Here, if we are selling the forwards, for example, so why he should? Because he is also aware about the situation.
Okay.
So how do you get the other party?
Who is the other party in forwards generally?
Generally, banks.
Exactly. So bank ke liye to it is their business, na?
Still
They are
they
not
do
going to
this.
give any service for free. Do you agree with
No,
me?
that is true. Still they do this.
Yeah. So what they do is they also are, say for example, let me put it this way. If a bank is essentially doing this transaction, they are not going to keep the position open-ended in their books. So it is not like they are willing to take the risk. So say for example, here, let's say I reach out to Axis Bank, for example, okay? Just for an example, I reach out to Axis, I am an exporter. So I reach out to Axis Bank that I have a receivable of 10K, which I want to get a forward cover on. Okay. So they say that, okay, we are going to give you a rate of, let's say, rupee 80. Are they going to sit on this particular exposure? The answer is no. They are immediately going to hedge it again in the interbank market and go and reach out to another bank, right? So they will essentially reach out to another bank and thereafter cover their position, right? Since this is sold at, or rather they have agreed that we will buy the currency at 80. So that means they will have to sell that currency, right, in future.
Yes.
So they will essentially sell a forward over here where they are going to sell the dollars in future. So say, for example, if the due date over here is 30th June 25. So with the same timeline, they will say, okay, 30th June 25, I will deliver so many number of dollars, which is 10K over here. So I will deliver 10K and they will try to fix up the rate today itself. So somebody who is giving him, let's say, for example, 80.25, 25 being their margin, for example. Right?
Okay.
So they buy at 80, they sell at 80.25, thereby making a clear profit of 0.25. And if you see now from Axis Bank's point of view, as on today itself, what is the date today? Say today is 3rd June 2025. So what has Axis Bank done today? Axis Bank has essentially agreed with exporter that, okay, I am going to buy this particular currency from you. So there is a forward which is being agreed with them. They are already selling it and agreed rather they are not paying today. They have only agreed that on 30th June, they will purchase this 10K dollars from them at 80. And today itself, they have entered into another transaction with another bank that they will sell this 10K in future at 30th June 2025 at 80.25. So by default, they have already entered into a transaction which will give them a profit of 0.25 per dollar.
Okay. Thank you, sir.
So in their books, they are not carrying any risk, right? Have I answered your question, Mike?
Yes, sir. Thank you.
Okay. All right. So this is about netting and money market hedge. Remember, in case of netting, you will not be able to have the natural coincidence every time. And that is the reason we need money market hedge to create that coincidence of matching the dates. Right? Which is the next approach. Next easier way out, which we all have learned, and that is, which I just now spoke also, which is forward exchange contract. So what is forward exchange contract? Say, for example, as I just mentioned, if I am an exporter, right, I have sold some goods to the importer. This is importer or customer, and he has to pay me $10K. This 10K is payable 3 months from now. 3 months from now. So say, for example, the due date is 30th September 2025. So immediately what the exporter does is, I don't want to keep the exposure with me. So he reaches out to the bank, right? And he will buy a forward for sale of dollar 10K, which again matches with this particular date. Now here, as a result of that, say for example, today in the spot market, let's say the rate which is going on is $1 is equal to rupees 65. In future, it may become $1 is equal to rupees 66. Let's say this is the forward rate which is being offered to you. This is the spot rate which is offered to you, right? Spot rate today, forward rate is 3 months later. That is on 30th September. So you are taking this particular position that I will get 66. Now it is quite possible, considering we have yesterday discussed about interest rate parity principle. We have discussed about purchasing power parity principle. And as a result, you know one thing for sure, India is definitely more inflationary generally compared to US. I'm saying generally, right? Because in the last 3-4 years where they had suddenly very high uh, bills of electricity and energy was becoming very expensive, especially particularly post after the Ukraine-Russia war, because majority of the energy for Western countries were essentially coming from Russia, right? They were essentially importing LNG from Russia. And that logistics having changed, obviously energy became expensive and thus creating certain inflationary tendencies in those economies. But traditionally, if you will see historically, they have had very, very low rates of inflation compared to India. India has been having generally high rate of inflation. And what does that do? We had learned that also, that as a result of that, as a result of the interest rate parity principle also, what will happen is you are obviously expecting that dollar will become more expensive over a period of time, right? So it is quite possible over here that probably in the spot rate, that $1 spot rate 3 months down the line may actually be rupee 67 or even 68, for example. This is a possibility. But do I want to take that risk? Because it is also quite possible that because of the various changes which are announced, and a lot of the times the US president currently has been giving certain indications which is not directly in consonance or the expectation with the market, right? Market is expecting everything is good, now let things go. And suddenly you find some tweet coming up or some other announcement being made by the US president. And as a result, market really goes in for a toss. That can obviously have an impact on the forex rates which are prevailing in the market. Do I want to take that risk? And I am an exporter who does not want that risk. Any which ways, today, as per the spot, I have booked my obligations as per rupees 65, and yet 3 months down the line, I will still get rupee 1 more. So I'm better off that way. I don't want to take any risk. Forward is a very good option for me, right? Because by doing this, now in future, whether the rate is rupees 68 or whether the rate becomes rupees 62, I am fully covered. It does not bother me. I will get my rupees 66 as has been agreed in the forward exchange contract, right? Now, we need to compare these options also, wherein which option or which particular opportunity or approach may be beneficial to me. So before I go ahead with the questions, etc., let me further again mention there are other techniques or approaches also available, right? So let me cover all the approaches to start with. One of the other approaches is also currency futures. What is the meaning of currency futures? Yes, anybody?
Here, without the delivery or of the currency, only the margin will be squared off, settled,
Very good. So
like
as a result,
equity.
So you are essentially going to be dealing in differences, right? Whatever are the variations, you will capture that and you are going to essentially consider the variations. You are protecting yourself against the variations because any which ways, I mean, mathematically speaking, it is a standard deviation, right? The risk which you want to essentially cover. That this is the rate, say for example, if the rate today in the market is $1 is equal to rupees 80. Now $1 in future will become rupees 82 or it may also become rupees 78. So you can see over here, there is a variation which is there of almost 2.5% plus or minus. This is what I want to capture and currency futures allows me that. Now this particular topic you have learned in your derivatives product, right? When you were studying derivatives, You have studied over there. So this we will not be exploring in detail, except when we are going to do a couple of questions where we do some comparisons. Similarly, I also have one more option, which is currency options. Again, this is something which you have learned in derivatives options. So you have a call option and put option, right? So I have an exporter. Who has receivable of $10K. He has a receivable, which is going to be coming to him on 30th June 2025. Now, he is obviously a bit concerned that market may essentially change. So in that case, he is considering currency option. So what would you recommend to him? What do we recommend to him? Call is basically an option which gives you right to buy, right? This is the option which will give you right to buy, while put option is right to sell. Now, since here my receivable is in $10K and my local currency is INR, so I'm going to say I want to have a right to buy in a dollar denominated option, right? If your option is dollar denominated, then I want to exercise a call option in future so that I will have an option to buy that particular amount. Now remember, it is an option, it is not an obligation, which means if the market, the spot rate in the market is going to be better than the option price, what I will do? If the option price is going to be inefficient compared to the spot price, then you can always let the call expire and you would rather go to the market and buy it in the spot market. Say, for example, here we say that I have a right to, here I don't need to buy, I need to sell, So here I will, because I already have the dollars, so I'm going to sell dollars, okay? It is dollar denominated. So I'm going to essentially sell my dollars. Say the rate available to me on the put option is $1 is equal to rupees 80. This is the put option which we are going to have, right? Because I already have a receivable on 30th June. So on 30th June, I want to sell the dollars. So I'm going to buy a put option. Say, for example, the spot price at that particular point turns out to be $1 is equal to 82. Would you sell it exercising the put option, or would you sell it in the spot market?
No, we will not accept because price is more.
I am getting more money in the spot market, so obviously I will allow the put option to expire, right? I will essentially go and sell it in the spot market wherein I get 2 rupees more. Am I right?
Yes.
Now, here there is one aspect to be understood, and that is my put option is dollar denominated. Okay. What if the put options in your market are not in dollar denominated, but they are rather rupee denominated? Then what you do? Then in that case, basically what you are trying to say is, I want to essentially sell dollars, right? But selling the dollars means I want to buy rupee. Am I right? When I am selling the dollars, I am going to get rupees. So indirectly, I am buying rupees and selling dollars. Now, since my contract is dollar denominated, then I can definitely exercise a put option. But what if the contracts in my country are not in dollar denominated, but they are rather rupee denominated? Then in that case, I will exercise right to buy, which is a call option. Are you with me? Because I want to buy rupee, sell dollars. Same aspect or the same cover will be available to you over here also. For example, say $1 is rupees 80. So that means that I have a right to buy rupee currency, and for that, how much will I have to pay? For every dollar, I will get 80 rupees. In other words, for every 80 rupees that I buy, I will have to pay $1. It is the same thing, just a corollary, except the fact that whether the denominated currency is dollar or rupee. So if it is a dollar denominated, I will buy a put option. If it is rupee denominated, then I will buy a call option. So please be aware about this particular aspect, right? So first thing you need to ask is whether the options are available in that particular currency or not, and then you choose which option to take. Next is obviously currency swaps. Currency swap essentially means where I am swapping my currency obligations with another person. So if I have a dollar denominated liability in my books, I am an Indian guy, okay, and I have a dollar liability. There is another person who is in US and he has a INR liability. Then we basically swap our obligations in such a way that I will have INR liability and the US guy will have the dollar liability. The difference obviously will be settled in by payment of the differences. Because there will obviously, when you are settling your INR liability or dollar liability, there is a certain interest rate which may be there or expenses may be there. That will essentially be covered through settlement. So that you will have to pay out. But otherwise, an Indian guy will essentially have Indian liability and US dollar guy will essentially have a dollar liability. Now, all these three approaches are covered under your derivatives module, right? Now, let us consider a couple of questions which I have shared in our exercise so that we can essentially understand how it's going to go about. So let us take question number 7. Question number 7. Question number 7. Let me take the question also over here. I believe I have already shared this particular session. It's available to, the revision questions are available to all of us, right, in the assignment. For easy reference and convenience over here right now, I'm going to copy paste the question and take it on the Excel file over here, right, for everyone's easy reference as such, but you have the question available with you already. So this is the question. Which are the approaches which we are comparing over here? Export limited and export oriented unit invoices in the currency of the importer. It is expecting a receipt of US dollar 240,000 on 1st August 2022 for the goods exported on 1st May 2022. So what is your spot date? Spot date right now is 1st May 2022, and you will essentially be receiving this $240,000 3 months from now. The following information is available as on 1st May 2022. You are given exchange rates. So I have spot rate is 0.0125. Then 1 month forward rate is 0.0124 and 3 months forward rate is 0.0123. Currency futures, we are told, has USD to INR rate of May is 0.0126, July is 0.0125, and we are further told the contract size for futures. Currency futures generally have a contract size, right? So that is rupees 6,40,000. Now, initial margin to be paid out for May obligation, it is going to be 15,000. August obligation, it is 26,000. And interest rates in India for May obligation is 9%, and for August obligation, it is 8.5%. Meaning, if you are going to buy an option or rather a loan for a period of 3 months, then you will have to pay 8.5% interest. If it is in the same month of May, then you will have to pay 9%. On 1st August 2022, the spot rate USD INR is 0.0126 and currency future rate is 0.0125. Suggest a suitable approach to export limited that would be most advantageous out of the following methods. First is forward contract, second is currency futures, and third is no hedge. Assume that the variation in margin would be settled on the maturity on the futures contract. Now, this question was being asked in one of the previous examinations. I have taken this question from an examination question itself. It was there in our CA final exam May 2023, where this was a 6-mark question. Now, very important aspect to be noted over here is I have a timing 6 marks. So essentially, I have to complete this question in 1.8 minutes per mark, right? So that is, I need to target this particular question in 10 minutes time. So considering my timing limitation as well, and also out of these 4 options or rather 3 options which I have been asked, please first of all always try to track the ones which are the low-lying fruits in the question. Which are the low-lying fruits which can easily be done, right? Without having to worry a lot. So which are those 2 options? Out of these 3 options, there are 2 options which are very, very easy. Very simple. Which are those options?
Yes. 3 and 1.
3 and 1, exactly. And often it so happens with us chartered accountants specifically, because we are very, very meticulous, right? We go by order and step by step. So as a result of that, a lot of the times we lose sight that the first and the third is essentially going to give me predominantly very easy low-lying fruit. So my marks will be a lot easier. So I should complete that first, then go to currency futures, right? So I always suggest to my students that rather than getting emotionally attached and going by this particular order only, let me finish off first forward contract, second no hedge, and then we will go to the currency futures. I will number it properly. I will say 1 is forward contract, 3 is no hedge. Numbering has to be done properly in the examination, right? But I will follow the order, which will be easy for me to complete at the same time. I can get maximum efficiency out of it. So, I mean, no disrespect to the concept per se, but from examination point of view, you need to be a bit more pragmatic and practical about it. Always. So first one, what will be my receipts from a forward contract? Remember, this guy is a exporter, right? He's expecting a receipt of $240,000. So if he books a forward contract, what is the rate he's expecting? Yes. What is the rate he is expecting? He is going to have $240,000. So what is the rate he is going to get? What is the 3-month forward over here?
0.0126.
0.0123, right?
Oh,
this is the 3-month forward, isn't it? What is the 3-month forward? 0.0123, isn't it?
Yes.
Am I right? Now remember, this is a rupee to dollar code, right? INR is in the denominator over here. I have dollars. So how do you convert this indirect quote into direct quote, where dollar will be in the denominator? How do you do that?
1 divided by 0.0123.
Exactly, into 1 divided by 0.0123, right? So I get the value over here, which will be how much? 2,40,000 into, or rather divide by 0.0123. How much is the amount coming to?
1 crore 95 lakh.
1 crore 95
95 lakh. 12,195.
12,000
195. 195.
195. 195. So here I have already got this answer, 1 crore 95 lakh 12,195. So I have got this first option, forward contract covered. Now, rather than going to the second option, I'm going to first of all solve the third part, which is no hedge. If there is no hedge, that means I will essentially have to cover this 2,40,000 at what rate? Into 1 upon. At what rate? Because there is no forward, there is no future over here. This is no hedging. So I am essentially going to expose myself to whatever is the spot rate at that particular point in time. Am I right?
0.0126.
0.0126. From where did I get that? You can see over here the spot rate as on 1st August, right? As on 1st August 2022, spot rate is 0.0126. So I will get that particular rate for no hedge.
90 lakh.
1 crore 90
lakh.
90
0.
lakh.
47.
47.
619.
619. All right. So I already have the two options being covered now. And we can see over here, the reason why I mentioned this is, assuming this is a 6-mark question, right? My final answer, because I will need to give over here, suggest a suitable approach. So out of this, I will have to essentially identify that. So say, for example, that final answer has 1 mark to it. And forward contract, because it is a 1 item, so it is going to have 1 mark. Hedge will have probably 1 mark. So I have 1 and 1 easily now captured, right? So my 2 marks are already guaranteed over here. Further, this no hedge value also plays a role in my currency futures valuation. How? Let us see. Yes. So now we talk about currency futures. So for currency futures, first and foremost, I will need to see how many contracts I will need, isn't it? Because you have a contract size over here. What is the contract size? 6,40,000. Am I right?
Yes.
6,40,000. Okay. So for determining 6,40,000, I will first of all need to convert the dollar into INR because my contract size is in rupee terms. So at which rate should I essentially take? At which rate should I take?
Today's spot rate.
At today's spot rate?
0.0125.
0.0125. Yes, very good. So I am going to essentially have first of all identified how many number of contracts. Remember, we are doing right now the second option, which is currency futures. So the number of contracts I am trying to determine. So how will I get that? $240,000 into 1 divided by 0.0125, right? And further, this has to be divided by, I can say again, this 6,40,000. I hope you are able to understand why this 6,40,000, because that is the size of the contract. When I multiply 2,40,000, or rather into 1 upon 0.125, I will get the value in INR terms, and that I divide by 6,40,000. So I get the contracts. Now remember, contracts are not divisible.
30.
I get the exact number 30?
Yes, sir.
Yes.
Oh, very good. So I get 30 contracts, right? All right. So now I have got 30 contracts. How much initial margin will be payable now? Initial margin you are given 2, right? There are 2 amounts which are given to you. So initial margin you will have to pay on each contract. So I will have to pay 30 contracts into. Now in the question you are given 2 options.
Select a piece of question.
Initial margin for May it is 15,000 and for August it is 26,000. So you will have to pay for, because I am going to buy contract which is for 3 months, isn't it? My due date is 1st August. So I'll have to pay as per 26,000.
6,000.
So I'm going to have over here 26,000, which is being paid out by me That means I'm paying out how much? 25.
7,80,000.
7,80,000. Yes, thank you. 7,80,000. Further, now I will hit receipts. How much am I going to receive on the due date? So receipts from what? Receipts from
2,40,000 US dollar.
yes, receipts from sale of proceeds, which is $240K. Okay, all right. So again, this amount will be at what rate? This will be at what rate? The rate
1.0123.
No.
एक बार सर आप क्वेश्चन पूरा दिखेंगे बस.
Okay. By the way, I have shared these questions, so you all have access to that.
0.0125 currency future rate.
Are you sure?
Yes, sir.
0.0125 or should it be 0.0126?
सर spot rate थोड़ा लेना है, currency future rate लेना है.
हाँ, and currency future rate क्या है?
No, sir, it's 0.0126.
Why 0.0126 आप लोगे? बताइए मुझे.
It is because when we are going to materialize it, the spot rate is 0.0126 on 1st August.
So here, essentially what happens is, I will have to convert it at what rate? I will close it at the day when the rate is 0.0125, which is currency future rate. However, remember when I'm going to sell it in the market at that particular point, market is giving me what? 0.0126. So I will take that, which is nothing but the amount which I am getting out of no hedge position. Am I right?
Yes. Yes, sir.
Now, why will I do that? Just a minute, please. So, yes. So here I will have the same number essentially arriving over here of 240,000 into 1 upon 0.0126, right? I will get this particular amount. You can see over here something which is similar, which we have already done earlier in no hedging. And why is that so? Yes. I have a variation which is happening, am I right? Or no? Is there variation happening? So 1 crore 90 lakh 47,619. This is the receipts which are going to come from sale of proceeds. I need to check if there is any variation which is going to happen. Is there any variation happening in the futures?
Margin?
Yes. Check. What is the future currency future rate? Can you see this?
0.0125.
0.0125. And what is the rate at which you started converting your contracts?
Same.
So is there any fluctuation over here? There is no variation which has to be adjusted. Are you with me?
Yes, sir. Okay.
Yes, sir.
So I don't have any variation because there are three things which will come in case of currency futures. One is receipts, the other is variation in the value, and the third one being interest, because I have paid this initial margin. So I have already shelled out this money upfront. So for those 3 months, I will have to pay interest, right? 7,80,000 I had to pay upfront. So here I will have interest to be paid. So I will have less interest cost. Why am I doing this less? Because it is a cost for me. So my proceeds to that extent will reduce, right? So how much amount will that be there? 7,80,000 into, what is the interest rate for 3 months? 8.5%, right? Into
3
3 by
divided
12.
either I say 3 by 12 or I can say 90 by 360. Okay? Because it is for a 3-month period. Yes.
16,575.
16,575. Now remember, this is less. So I have 190.47 minus 16,575. How much will that be? 190, 31,
31,044.
044. Okay. So now we have 3 options available right in front of you. 190.31, which is the third option. Second option. Third option was 190.47, no hedge. And then you had 195, 19195, which was from forward contract. So which is the most optimum option for you?
Forward.
Forward. So I will essentially
Sir,
suggest to you. I'm sorry.
सर एक क्वेश्चन था
बोलो ना बोलो.
अगर इसमें वेरिएशन होता तो हम कैसे एडजस्ट करते?
Actually, I have taken one question for that also, beta, specifically for that.
Okay.
Which is
Okay, thank you,
the
sir.
question number 4. So same, you will have more or less same aspects as such, where you will find couple of information is more, and that will allow us to calculate for that particular variation as well. So the idea of giving you these 2 questions was, this is a 6-mark question, remember, and the moment variation comes in, it will become a 8-mark question. Okay. So here, forward will be the way to go. Now remember here, you will need to mention over here, because uska mark hai, forward contract provides maximum, you can say optimum proceeds. Thus chosen. This one line carries 1 mark. So please don't be under the impression मैंने 3 calculate कर लिया, मेरा काम हो गया. It is very apparent on the face of it. Don't be under that impression, because you will have to write this comment. This carries 1 mark. So from examination perspective, this will have 1 mark. Here, this will have approximately 3 marks, right? This particular number. So you have a kind of a breakup where you will have 780, 190.47, and 16,575. They will have the total of 3 marks. And then 1 mark each for your no hedge option, right? Your no hedge option will have 1 mark, and this one will have 1 mark. Are you all with me? Okay? All right. Now let's do that one question which Madam was just now talking about, right? Where we have variation as well. So that is question number 4. I'll take the question number 4 also over here. Question number 4, I will take it on the screen. Let's see. Is it visible to everyone? Let's see. Okay. Now this, ma'am, are you there?
Yes, sir.
Hello. Sorry. Is this question visible to everyone?
Yes, sir.
Yes, sir.
Okay. So EFD Limited is an export business house. The company prepares invoice in customers' currency. Its debtors of US dollar 10 million is due on April 1, 2015. Market information as at January 1, 2015 is exchange rates US dollar to INR, spot rate 1 month forward, 3 month forward. Currency futures, contract size 1 month, 3 month. Initial margin is given to you for 1 month and 3 month. Interest rates given for 6.5% and 7%. On April 1, 2015, the spot rate US dollar to INR is 0.016136 and currency future rate is 0.016134. Which of the following methods would be most advantageous to EFD Limited? Using forward contract, using currency futures, not hedging the currency risk. All right. So now, let's start. First option, using forward contract. That is a low-lying fruit for us. What will be the receipts over here? Receipts using a forward contract. Yes. How much will be the
$10 million
10 million?
US dollar.
Yes, 10 million USD into. Now remember, the rates are given to us as USD to INR, right? We are given
Yes.
over rates which are USD to INR. I want INR upon USD, so I can multiply, which means I need to convert indirect quote into direct quote. So I will say 1 upon
0.0101612
0.1612 So that come to, does that come to
62 crores.
62 crores 1,240.
Yes.
So from where this rate 0.016129, where is that in the question?
Sorry.
Actually, 3 months forward. Yeah.
You can see over here, this rate is there.
Oh,
It basically, I think when I copy pasted
rounded
it,
off. Yes, yes.
once, sorry for that. Let me, do I have 6 digits everywhere?
Sir, in question is completely given, so it's okay.
Yeah, in question it is given. I
Yeah,
try to copy paste over here
Yes,
for the
yes.
benefit of everyone who is looking at the screen. The only difference is if you have the, I mean, we have obviously shared this particular entire question list. The advantage is you get it right in front of you on the screen, then you don't have to do alt tab, etc. If you have taken the printout, then it is obviously an added advantage, right?
Yes, sir.
All right. So my 3-month forward rate over here, I can put it over here. All right. So this is my receipt using forward contract. Now I'm going to go to the third option, which is not hedging the currency risk. In that case, what will be my receipts? Remember, as I mentioned earlier also, in the examination, I need to be a bit pragmatic, not get too emotionally pulled in. So I'm going to take the low-lying fruits first, right? So no hedging option. Now, of course, in the examination, obviously, if you want to do the second option first, obviously you have that choice available with you. I am doing it this way so that from examination perspective, it helps me. But again, each one to his own. If you think my option makes sense to you, you may follow it. Otherwise, obviously, you are the best judge of what you want to do. Yes. Here,
Spotted. 0.01667.
no hedging option.
Yeah.
Will I get the currency today, my dear?
Yes.
Will I get the currency today?
No,
To receive the currency when? Is due when?
1st April.
Oh, sorry. 0.016136.
Exactly. 16136. Right? So I get 619732 275.66.
Yes.
Now we go to the second option. Shall I solve it over here on this side? Is it okay? Because then it will be at least having a visibility.
Yes. Parallelly visible.
Yeah, exactly. You will have visibility. So I will put this in bold so that you can identify the difference. Okay. This is not part of the question. This is part of the solution. So, okay. So here we have the second part which we are doing. I hope this will be better for everyone, right? From visibility perspective. You have the question right in front of you. All right. Now, using currency futures. So first and foremost, I need to identify how many number of contracts will be there. So how many number of contracts will be there? How do I get that?
10 million divided by 24, 816,975.
Number of contracts that you will be essentially taking is how many? You are going to take at what rate? 10 million. What is the 3-month future rate? Can you see the rate over here? That is exactly matching my rate, right? Now, this is one difference which is there compared to your previous question. And I will show you that previous question change as well, which is very, very important. It might not appear so, but that is a very, very important change. Let me just complete this particular value. Divide by, or rather I should say into 1 divided by 0.016118. Where have I got this 16118?
3 months forward.
Future rate.
3 months currency future.
Yes. And in the previous option, did you have that? In the previous question? Previous question, did you have that? My contract size over here is 24816,975.
25.
So I take this, put it over here. $25 contracts. Is it visible to everyone?
Yes.
Is this easy and visible, or do you want me to start writing? I can do that as well. I just thought calculation will be a lot easier. So that is the reason I've done it this way. Does this make sense? Again, I repeat, number of contracts. So first of all, my contract value total is $10 million, which I'm going to get. I obviously convert that into INR at which rate? At 3-month forward rate. Now, just now I mentioned to you, there is one important change between the two questions. So please have a look at this particular aspect, which I want to draw your attention to. April 1, 2015. What is the date today? January 1, 2015. So precisely 3 months later, it will be April 1, 2015, which is matching with my due date. So I have a 3-month currency future available with me. What happened in the previous question? In the previous question, please have a look over here. My date was 1st May over here, right? Remember, amount was falling due on 1st August, which is 3 months from now. But the currency futures over here mentioned was for May and July. Not 3 months later, only 2 months later. Are you with me? That is the reason we had taken over here currency future rate 3 months later. So there is no price variation which was happening over here. Now you will have a variation happening over here. All right. So first and foremost, I have number of contracts available to me, 25. So now how much is the initial margin which I will need to pay? Initial margin per contract I have to pay is
22,500.
22,500.
Initial margin matching with my due date is 3 months. So that is 22,500 which I will have to pay. So I have 25 contracts into 22,500. So that is going to be 562,500. I will just use the round off function over here just to be avoiding any challenges. Okay, all right. 560,500 is my initial margin. What is the receipt I'm going to get now? What is the receipt I'm going to get? Receipts from, yes, receipts from
Future option.
sale of currency, right? How much will that be?
1,708 is possible.
Do you recall from the previous question as well? This value is generally very similar to the no hedging of the
Same.
currencies.
Same no hedging.
Exactly, same as no hedging. Right? It will be this amount over here. Is it still visible to everyone?
So can we take these as a thumb rule? I mean, generally, the no hedging rate and future rates, I mean, realization, proceed will be the same.
You will have to adjust the variation, right? Now,
No, not variation. Before that, just this figure, 10 million divided by the rate. To that extent, not other differences.
okay. So currency future, by the way, what is the future rate available to you? Can you check over here? Can you see over here? What is the currency future rate available?
Yeah, 016134.
And spot rate is higher than that or lesser than that?
Higher.
You had essentially fixed it at what rate initially to start with? Can you see this?
16118.
16118. And now you are going to get what? So what is your spot rate? Is it higher than your currency future rate or lesser than your currency future rate?
Higher.
Higher. So say for example, if your currency future rate over here was 0.016110. So your no hedging option would have been obviously at 0.016110 because that is the spot rate. But in that case, would you essentially avail the currency future value? Because the spot rate is lesser, will you essentially exercise that option?
No.
So you will try to get the benefit from your futures position which you have taken, right?
Yes.
All right. So now next is the variation margin. How do you compute variation margin? Variation margin. This was not there in the previous question. And that is the reason this particular aspect of this calculation itself gains you 2 marks extra in this question. So this question is of 8 marks, while the previous question which we did was a examination question, remember, for 6 marks. Variation margin, the moment it is asked, it becomes a 8-mark question. Now what I am going to do is I am going to do the easier part first now again. What is that easier part? Interest cost.
Interest.
Interest on what? Interest on what? 560 to 500.
Initial margin. Yeah, initial margin.
Yes. Into at what rate? 3 months.
7%.
7%. So 7% into, it is 3 months, right? So 3 upon 12 or 90 upon 360. Here it's already mentioned in months. So I write 3 upon 12.
9843.5.
9843.75?
Yes.
Right? Okay. Keeping in tandem with my approach, always take the low-lying fruits first so that I remove the risk element out of my approach. Right? That's always been the way I essentially try to solve it. That helps me in maximizing whatever I know. Sometimes, otherwise, we get sucked up into this, and as a result of that, my next part can go wrong. All right. So now, interest cost I have already computed. Now I will have net receipts. Now, net receipts is going to basically be a part of 3 things. So I will have receipt minus interest cost and variation margin, positive or negative, that I will recover from the currency futures. Am I right? That is what is going to come to me from currency futures, because I will essentially ensure that my futures is essentially paying me for that difference. All right. Now, what is the difference? How do we go about computing this? Yes. So how do I go about computing this? I have 25 contracts on which, if whatever is the variation, will be there on each of the 25 contracts. Am I right? Yes or no? Each contract is of what value? Contract size क्या है? 24816 975. So this is the difference, and now I need to work out on what will be my variation margin. By the way, what is the variation margin I am looking at? So I am looking at my currency future rate has become 0.016134 minus what was earlier being agreed was 0.016118. Am I right?
Yes, sir.
So in the future itself, you have a adjustment happening over here, 0.016134. 0.016134 बराबर है? नहीं, क्या मैंने कुछ गलती की है?
10 is more.
10 is more, yes. Minus 0.016118. This is the difference which is there, right? The variation margin. Now remember, this value is going to be in terms of the entire variation margin per se, and I am going to receive this entire value. Just 1 minute. So this is the variation margin, right? And I am going to essentially further convert this at what rate? I am going to convert this at the spot rate. Try to internalize this. What is happening? So say, for example, we have 25 contracts. 25 contracts into 2481,6975. Now, look at it this way. My contract was for 10 million US dollars, right? Which we had converted it at what rate originally? At the future rate at that time of a 3-month currency future rate of 0.016118. Now the rate is 0.016134. So that being the, 16 points is the change, right? In the last 2 digits, if you see. So that being my variation, I'm comparing that, or rather multiplying that with all the 25 contracts multiplied by the contract size value. So I get the total variation margin, and then I'm going to convert that particular value at spot rate. I'm going to convert that at spot rate, which is 0.016136. Are you with me?
Yes, sir.
So what will this amount turn into? This amount is going to be, what is the problem?
Single quote is ahead of equal to sign.
There is nothing before equal to, after equal to is there. Have I closed the commas? Seems to be the problem. When the first character is an equal to or minus sign, Excel thinks it's a formula. It is a formula. Okay, let me change the bracket. Hmm. 615,195.2157. Is everyone getting this? 615,195.
Why did we convert it into spot rate, multiplied by spot rate, ultimately, finally, in this?
I'm sorry, can you come back, please? What's your good name, sir?
I'm Prashant.
Yes, sir, please.
So why did we convert it into spot rate, finally? This part I could multiply by.
All right. So currency futures is giving you an option basically, right? You want to be in the same position as you would have been. Am I right? Hello, sir.
Yes, sir.
So today's spot rate is better off compared to your future rate.
Yes, sir.
So at the end of the day, whatever variation margin I will receive, I am going to convert that at what rate? Imagine this is the dollar which you are going to get. Say, for example, you are going to get $1, right?
Okay.
Because what you are doing is, it is USD upon INR, right?
Right, sir.
So it is basically, we are thinking that this is INR, but actually it is happening at what rate? This is a dollar.
Dollar rate. Right, sir.
Right? So dollar deviation which you have calculated in between 0.16118 and 16134. So that is a dollar which you have received. That dollar you are going to discount it at what rate today? At spot rate. Because
Yes,
you
sir.
have not taken any cover for the variation margin, right?
Correct, correct.
All right. So now, what will be your net receipts? What will be your net receipts? 6197 plus 1 minute. Let me make it easy for you also over here. Let me put it this way over here. This is, for example, A. This is B. And this is C. Then what is going to be your net receipts in that case? It will be A plus B minus C.
Minus C.
Okay. I hope it is easy to understand then in that case for everyone.
Yes, sir.
So I have 62 crores 3,37,627.12. Now you have all three values available in front of you. this is from my using currency futures, this is from my forward contract, and this is from my no hedging. So which is providing me highest value?
Currency
Currency
futures.
future.
Currency futures. Now remember, please remember, we chartered accountants sometimes miss out that after we complete the audit, we still have to submit the report, right? Similarly, after the computation, you need to give the final answer. Otherwise, you will lose that 1 mark which you have already earned. So which of the following methods would be most advantageous to EFD Limited? So we have to mention over here EFD Limited, EFD Limited would be most benefited by which option? By
Currency future.
using currency futures. Okay. Now, I am going to even consider probably the best option over here. So you can even do the calculation 62,03,337 minus 62 1 lakh, etc., and say that this is the incremental benefit. But having said that, that is not going to yield me any extra marks. So I'm not going to do the effort. In the examination, remember, I am having a time crunch. I have only 180 minutes. So I'm not going to waste my time on trying to compute the difference over here, for which I'm going to get no marks. In reality, in real time, we always write that in our reports. When I submit to my client, I try to do that extra aspect to identify and benefit, right? So in your articleship also, you might have observed sometimes your principal also must be saying, let us identify or highlight the benefit, right? Let's quantify. Because say, for example, if this was a difference of only 1,000 rupees, then for 1,000 rupees, do you want to do this effort or that effort? That could be a consideration over here. So we generally try to even monetize what is the incremental value. But in this exam, in question, here you have 3 hours only. So we need to be very, very conscious. Okay? Is this done for everyone? Can we proceed ahead now?
Yes, sir.
Yes.
All right. All right. Now, so we have covered over here in this one question, we have covered 3 options of hedging. As I said, no hedging is not really a hedging technique per se, but yes, it is an option available to the party, whether they want to hedge or not. So we considered over here forward contracts, currency futures. Now we'll look at one. Okay, it's 8:33. Shall we take a break now? Shall we take a break now?
Yes, sir.
Yes.
Ashok, can we take a break, please? Okay, thank you, sir. All right. So we compared the three approaches in previous question: no hedging, forward contract, and foreign currency future. Right now, in those questions we took for as far as forward contract was concerned, it is a very easy approach. You just book the forward contract, and the underlying assumption was on the date of maturity, you will either deliver or receive your foreign dollars or whatever is the underlying currency and pay for the same in due course. However, practically, how does the same happen? So, let's say, for example, I have let's say, for example, I have so at the start, when does a contract start? Basically, forward contract will start or come into being when you enter into contract, right? So it contract will start when? At the date of commencement. Obviously, logically, only after you enter into forward contract that the contract comes into existence, right? Now, say for example, this contract has started on 3rd of June. 3rd of June 2025. All right. And this is a 3-month contract of $10,000. I am an exporter. So exporter. Okay. So I'm going to receive $10,000 3 months from now. And for that, I have purchased a forward contract. Now, as we have noticed sometimes that maybe I can essentially make the payment with early delivery. So this happens especially with regards to, do you remember, leading and lagging as an option? So maybe my client or my customer is essentially saying that I want to pay early. Then in that case, I receive the delivery early. And at that particular point, I might obviously need to settle this particular contract. Similarly, it is quite possible before the due date. Let's say my due date 3 months is coming over here. So this is the due date, right? And before the due date, there is a cancellation because I come to know that my customer is not going to pay, or I have already found some other use of that particular currency. Then I might have an exception of creating a early cancellation. I am an exporter. I had a 3-month contract. If my customer pays me early because he is opting for a leading option, he wants to pay early. So then I have an early delivery. I obviously need to settle this particular contract earlier. Am I right? Why will I keep the contract in continuance when I have already received the money early? I want to settle this account. Similarly, I may have a situation where now I am, as a result of early delivery or some other reason, I want to do cancellation. Early cancellation meaning this is way before due date, right? Now, I realize that my customer has reached out to me. I'm giving different situations, right, over here. There is also a possibility that my customer reaches out to me and says that I will not be able to give the money to you by 3rd September 2025. I need to extend it for another maybe 2 months or something like that. So then, because of that particular communication which I accept, there is also something known as extension, right? I would need to have an extension before the due date. Because he's come to me before the due date that I will not be able to honor. You please extend another 2 months for me. So he's asking me to extend. Now, obviously, because my receivable is going to get extended, I need to reach out to my banker also that the forward contract which I had taken, I will not be able to honor it. So I need extension, right? So I will need to do that back to back. So I go for my banker, take an extension before due date. There is also an option that, let's say, for example, on 3rd September, I'm waiting, and on 3rd September, my customer comes and says, sorry, I can't pay you. In that case, he says that, okay, I will pay you after a month or so, which means indirectly he's asking for an extension on due date. Now, the moment he is asking me, I also need to reach out to my bank and say, I cannot deliver on due date. And thus, I will also ask for the same thing, extension on due date. Am I right? Because on due date, what can happen is, one is you honor the contract. You honor the contract, meaning complete on maturity, right? Honor meaning complete the transaction. Complete transaction. Or there is an extension on due date because you are saying we can't do it today, we need to extend it. So your contract is getting extended. Or it is also possible. What is the other possibility also very much possible on due date? Your client is not going to pay now. For whatever reason, he has gone bankrupt or he does not want to pay or whatever, then in that case, on due date, you will have cancellation. Because now that is not going to happen. Now, this contract was due on 3rd September. Maybe 3rd September was falling on Saturday. I did not pay attention to it or something. And now I'm reaching out to the bank on 5th of September, which is a Monday. And I come and tell them that I'm sorry, I haven't received the money from my customer. He has asked for extension. So I also reach out to you asking for an extension. So you're reaching out to the bank for extension after due date. After due date. Right, which is also known in our parlance, or rather in our subject, we call it as late extension, right? Okay, so let us summarize all the different cases which are possible. I enter into a contract. There's a possibility that my client might be following a leading or a lagging as an alternative. If he's going to do leading, that means he's going to deliver it early. If it's a lagging option which he wants to essentially avail, he might probably ask me, give me 1 month extra. You charge me interest, but you give me 1 month extra to pay back and whatnot. In which case, I will have to reach out to my banker for either cancellation or extension before due date. On due date, what can happen? Either you honor or there is extension on due date. I cannot pay, so please extend the deadline for me. Or you are not able to pay at all and you are not even seeking extension, I can't pay. That means effectively you are cancelling the contract on due date. And worst case scenario, most of the times people are very, very alert and agile, but sometimes it also happens that inadvertently you happen to miss the due date. And you happen to miss the due date and then you reach out to your banker for a request of extension after a due date, that is called as late extension, right? So as a result of this, now, what are the options which are arising for us? If I try to summarize this, Yes. Now I have three options coming in each of the situations, which is that there is a delivery, then there is cancellation, and there is extension. From the situation we see over here in this entire possible, we can say, lifetime existence or the events which may happen over the entire life of the forward contract. What are the different possibilities? We have this three options, right? Delivery, cancellation, extension. And in each of them, we have basically three options which are again going to come up. What is that? You are going to have early delivery, or you will have delivery on maturity, right? And the third one is going to be, you will have late delivery. Are you with me? Are you all able to follow this? Early delivery meaning I am able to deliver my foreign exchange before the due date of the contract. I am delivering the foreign exchange on maturity, which is as per the contract. That is what forward contract was essentially entered into for. I deliver the currency, they give me the INR, contract is settled. And third one is late delivery, where I deliver, but I deliver later than the due date. Similarly, cancellation also, you can have same, again, three aspects or three options. It can be early cancellation. What do you mean by early cancellation? Prior to the due date, right? So you have early cancellation. Then you may have cancellation on maturity or due date. And third one is late cancellation.
Sir, what happens on cancellation in either of the scenario? Matlab early or on maturity or late? What will happen?
Yes. So I will discuss that also, sir. Just 1 minute. I'm just laying out what are the options, and then I will also do the linking part, how they are essentially linked with each other.
Okay, sir.
Right. So again, extension also, I have three options. So early extension, I am assuming you guys are on board with it. So I'm going to take extension on maturity, and then obviously late extension. Okay. All right. Now, first and foremost, what is the easier and the most efficient option? Delivery on maturity. If you deliver on maturity, the contract is automatically fulfilled. So that is the best way to go ahead. No problems whatsoever. Now, early delivery. So you have to understand one thing, first and foremost, forward contract, unless you are delivering it on maturity, that is, you are meeting the obligations on maturity, you cannot just cancel the contract like that. Why? Because based on my forward contract, which I have entered into with my bank also might have dealt with another contract with his intermediary, right? So can I essentially say, for example, your 3rd June to 3rd September is the due date, and on 3rd of July, I go and say, okay, I am giving you right now earlier. Now, is my bank essentially going to sit on that particular foreign exchange for the next 2 months? They obviously are not going to, especially because then in that case, they will have to take the currency and sell it into the spot market, and they suffer. If it is gains, fair enough. If it is losses, they suffer, right? Which they would not want to. So effectively, how do you terminate a particular contract? So in that case, what will happen is you will have to take an opposite position of another contract. Meaning, say for example, here I have a forward contract of sell contract, right? I have a sell contract which I want to close early. So what you will need to do is, let's say this is sell contract on 3rd of June 25. So in order to close this on 3rd of July 25, what I will need to do is my original obligation is that on 3rd of July, 3rd of September, this contract is going to fall due, right? Which is of sell. I'm going to sell here. But now, rather than doing it over here, This was just the contract entered into at that time, commencement. Now you want to sell it over here on 3rd of July itself. So here, if I want to sell over here, what you will also need to do is you will need to set up a buy over here. Are you in agreement with me? समझ में आ रहा है? Let me put the numbers into place so that it becomes easier to understand. Okay. So I have to sell $10,000 over here. Okay. $10,000 which I have to sell. Now I come on 3rd July and I say I'm going to give you, sir, $10,000 today. I'm going to give you $10,000 today. So you will have to take another forward contract because I can't terminate this contract like this. I will have to set up an opposite position. Only then I can close this position. So you can sell your 10K over here. Okay. I will take your $10,000. It's not that I don't want to. Banker is going to, obviously, they are never going to say no to the business. But then what they're going to do is, since you are selling me earlier, right? So you need to essentially buy another contract. You need to buy another contract for same 10K. What will happen over here is you will buy 10K from here and then sell it to me in my original contract. So this contract will get offset. So basically, if you see here, I had originally sell contract. Now what you have created is you have created a sell and a buy, right? This basically netting of the position per se from dollar perspective, thereby prevailing contract will be the original contract which will get satisfied. Contract cannot be terminated at will just like that. You will have to set up a opposite contract and then only you will need to fulfill it. Are you with me? I repeat once again, I have a sell contract entered into on 3rd June, right, which I need to deliver on 3rd of September. I have to sell the currency $10,000 on 3rd September. Because remember, the bank also would have committed based on this that you will sell, meaning bank is going to buy this 10K and then they have to deliver 10K to somebody. So if I am going to reach out to them and say, I want to give you 10K today, they will not say no for this business. But then they will say, you have to now, because you are selling me now, you have to buy another buy contract of 3rd September. So for these 2 months, you will have to buy another buy contract. So you will buy 10K over here and sell 10K over here. Are you with me?
Yes, sir. But even if the forward contract rate is also not beneficial to us, will have to do this.
Yes. So because the entire exchange rate risk now has to be borne by you as a customer, because you have reached out for a early settlement. So whatever is the variation which works out on as a result of that, that will have to be taken into account by the client, will have to be absorbed by the client. Right? Okay. Now, as a result of that, having said this particular situation, now what happens? Now, remember, we have 9 situations over here happening, right? So as a result of that, you can see if it is early delivery, then you will have to create another contract. Delivery on maturity, no problem whatsoever, right? Late delivery cannot happen. So again, you are going to have a new contract coming in, just like we did right now with early delivery. Late delivery also leads to the same thing. Cancellation. If you want to do early cancellation. So early cancellation means, first of all, I will have to cancel the contract now, but I will have to again set up another contract to meet my original obligation. Right? Are you with me?
Yes, sir.
So early cancellation, I will have to do that. Cancellation on maturity. Cancellation on maturity is comparatively easier. Why? Because then I don't need to set up any other contract. What I will do is I will just go and buy that particular currency in the spot market and deliver to my customer. So let's say I am the banker and you are my customer. You had said on maturity you will deliver $10,000 to me. Now on the maturity you are saying, sorry, cancel the contract. But I have taken a back-to-back contract with somebody else, right, to cover my position. So I will have to deliver to that particular interbank $10,000. So how do I go about it? I will go to the spot market, buy $10,000 and deliver it and fulfill this particular forward contract which I had entered into to cover my position. Now, in the process, I have made some charges. I have incurred some cost. Are you with me?
Yes, sir.
So when that cost or that was borne by me, I will have to obviously recover it from you. Now the question arises, sir, what happens if actually the forward exchange rate has been beneficial vis-a-vis the forward contract? So I had agreed with you that I will purchase your $10,000 at 85 rupees. And now you have cancelled the contract on maturity. And now when I go to the market to buy it in the spot to fulfill my obligation over here, I am able to buy it in 80 rupees only. So actually banker is saving money. Will this savings be passed on to the client? Because if there is a higher cost, you are passing it on to the client. So will the savings be passed on to the client?
No.
Savings will be passed on to the client only and only if he has informed about that particular cancellation up to the date of maturity. If it is a late extension, late cancellation, he has not bothered to communicate to me, then he will not get any benefit of this particular gains. Are you with me?
Yes, sir. But bank will give this pass on this benefit by default, or we have to ask for as a customer?
No. When they do the computation,
Up to maturity.
when they will do the computation for charging you the cancellation charges, etc. Because as a result of that, they have to obviously, even if they are buying from somebody, you have done the cancellation, so they will charge you cancellation charges, right?
Yes.
Plus additional transaction was done. So on that transaction, when I'm buying it for 80 also, I will still charge my margin on this new contract. So who will pay me that margin? The person who is selling the currency is not going to pay me the margin. I will collect that margin also from you, from the client. Are you with me? Okay.
Yes.
But I will pass on the benefit. So here in this example which I gave you, 85 rupees was the original obligation. I am able to buy for 80 rupees. So 5 rupees is saved per dollar, which means 10,000 into 5, 5 lakh rupees. 10,000 into 5 is 50,000 rupees is being a saving. So obviously, if after adjusting the charges, there is still a positive amount, I will transfer it into your account. You don't have to come and even ask for it because that is an obligation on the bank. However, if you have failed to inform me and cancellation has happened and I'm getting the benefit of this particular, like I was able to buy it cheaper compared to what was the forward contract. In that case, you are not eligible for any benefit because you have failed on your part to do any particular responsibility on your part. So the customer or as a client, you will not get benefit of the savings and yet you will suffer all the charges.
So,
Okay?
sir, this cancellation is not cancellation per se. Actually, though we call it cancellation, early or maturity or late, but since we have to enter into opposite contract, so this is not as such cancellation. It's just not striking of the contract.
Exactly. You are going to offset your positions, right? But because those 2 months extra, I mean, you have an obligation on 3rd September, but you want to cancel that contract as on 3rd of July itself. So how can you set it off? You can only set it off by taking an opposite position on the same day.
Okay.
So basically, what you are doing is you are getting into a netting option. You remember we discussed netting?
Yes.
Where the two obligations are of the same date, same time, and same value. So you can just net up them.
Yes.
The only difference being here, you don't have two different parties. You don't have to tell your customer, please pay to my supplier. That will not be there. You have with the same banker, you have two forward contracts. One is a debit, the other one is credit. Please set them off. Ho gaya kaam. Getting it?
Yes, sir. Okay. Thank you.
So that's the aspect which happens. But every time you do any cancellation, then obviously there is going to be a fresh computation and charges will be there. So that charges or benefits, if any savings are there, who will be entitled to it? If you have informed as a client, you have been proactive, you have informed to me on maturity or prior to maturity, you yourself have come to me and told me, sorry, I cannot deliver it. So then I am able to take some proactive steps, go to the market, buy it in the spot at cheaper price and sell it. Then the savings will be passed on to you. As I said, after the charges and all the other margins are adjusted, whatever is the savings, I will pass it on to you. But if you have failed on your responsibility, your duty to inform me prior, so that means my cancellation is happening because of your non-communication per se. You are not paying and you are not even communicating. So you have been least bothered about it. In that case, you get no part of the savings. right?
So can bank have the option to do all these things? I mean, cancel or early delivery? Can they ask early delivery or extension? From bank perspective, I am asking.
See,
Instead of
from a bank perspective, logically speaking, because they are the intermediaries, they cannot do that because it is kind of a position where you get a one-sided position, right?
okay,
Forward contract is basically your right to sell at a particular rate, and they have an obligation to honor that. So they cannot come back to you, and say that no, I want to cancel my contract, etc., etc. So that they cannot do. Legally speaking.
okay,
Practically speaking, if say for example, your particular banker has a particular need or requirement or something, and they reach out to you, and due to good relations, you are adjusting to something. That's a different thing. But again, it will still be initiated. The documentation will show that it is the customer who has reached out, not the banker.
okay.
Are you with me?
Yes, sir.
So even if it is at their behest, still documentation will show as if the client has reached out, because legally speaking, bank cannot come and renege on their promise. They cannot walk back on their contractual obligations. They cannot repudiate their contract. If they do that, their entire license will come into question, banking license. Because Banking Regulation Act and Reserve Bank of India Act are both very, very severe on that particular aspect.
Okay.
So they cannot do that.
Okay, sir. Thank you.
Okay. All right. Now, on this all situations, when you do at least one question on each of these situations, things become a lot more easier and clearer to you. Here, because this is a reversionary section, we are essentially obviously be focusing on one particular aspect, which we are going to cover. So I am going to cover only one particular aspect out of it. However, I would request, if possible, we have done some sessions on 2nd of December and 4th of December, right? Earlier regular sessions which were done. So we had done over here, you can see your Vostro Nostro accounts and all these calculations, all these sums of different due dates and liabilities. We had solved these sums in the sessions, right? So I would really encourage you, please go and solve this sum, because then in that case, you will get a coverage of almost each and every question per se, right? So that will really be good for you. This is something we had done on 4th of December, 2024. This session is available to you online, right? So I would really encourage, because every situation has been covered over there. Here right now, due to time constraint, we are going to focus on only one particular situation. So I am going to take over here question number 5 out of our revisionary cases over here, right? And in that, we are going to have cancellation, which is going to happen before expiry. Let me take the question over here. Okay. Now we have the entire question available on the screen. Question number 5, which we have shared in the revision question list in the assignments. A bank enters into a forward purchase TT, telegraphic transfer, covering an export bill for Swiss francs 100,000 at rupee 32.4000 due 25th April, and covered itself for same delivery in the local interbank market at 32.4200. However, on 25th March, exporter sought for cancellation of the contract as the tenor of the bill is changed. In Singapore market, Swiss francs were quoted against dollars as under. Spot USD 1 is equal to Swiss franc, right? So I have 1 month forward, 2 months forward, and 3 months forward available to me. And in the interbank market, US dollars were quoted as under. So spot, you have USD1 is equal to rupees 49.4302 slash 4455. Then you have spot April, spot May, and spot June, which is provided to you. Calculate the cancellation charges payable by the customer if exchange margin required by the bank is 0.10% on buying and selling. Read the question once again. It's there on your screen. This question will normally carry 6 to 8 marks, right? Shall we start? So first and foremost, your contract will be cancelled at TT selling rate. What is the TT selling rate which you have? Now remember over here, in the contract you are mentioned Swiss francs at rupee. And you do not have the direct quote between Swiss franc and rupee. So you have two elements coming in over here. One, this is a forward contract where cancellation is going to happen. Second, there is a cross currency calculation, right? So that is the reason, because of the cross currency calculation, this particular question will attract 8 marks. If it is a single currency where you have direct quotes available, then generally that question, same question. But if it was direct quote currency, then in that case, it will be only 6 marks. If you have cross currency, then 8 marks. So here in this particular case, you have a cross currency because direct quotation between Swiss franc and INR is not available. As you can see, in both the cases, you have the rates which is mentioned is US dollar 1 to Swiss francs, which means quoted currency over there is dollars. And then second time, again, it is US dollars, which is a quoted currency. So USD1 is equal to 49.4302, right? So as a result of that, what happens is we get a cross currency rates over there. All right. So first and foremost, let me cancel the contract, right? So the contract will be cancelled at TT selling price. So what is that selling price going to be for me? So what is the USD to INR? Is it a, sorry, INR upon USD spot selling rate? What is the spot rate? Yes,
4302.
Think again. You have a two-way quoted bid and ask price is there. So which price will be there?
Okay, so ask price.
Am I right? Why ask price? Why ask price?
Because we want US dollar for Swiss francs.
Excuse me, sir.
Yes, dear.
Sir, I accidentally joined the wrong class. Please, can you help me? I want to leave this class.
Okay, just 1 minute, please.
Thank you, sir.
Shagun, right?
Yes, sir.
Shagun, Miss Shagun, this is Shagun Tyagi, right?
Yes, sir.
Okay, I'm removing you, dear. Thank you. All right. I think Shagun, you are not there, right? Yeah, I have been able to remove. Okay. All right. So we are going to have over here the ask price. Why? Because I have to buy USD. Right? I will buy USD to get the Swiss francs. Now I need to add, because this is the spot rate, right? Do I know the premium? Do I know the premium? I need to add premium for which month? Yes. I have to add premium due 25th April. So this is the premium due on April. Am I right? So I will write, as far as premium is concerned, I will add spot premium, which is 4,200. Premium for April, which is 0.4200. Now, on this particular price, bank is going to charge its margin, right? Bank will charge exchange margin on buy and sell. How much is that? 0.10%. So 49.8655 into 0.1%. How much is that going to be? 0.0498655. Okay, this plus this. So I get 49.9154. What are we trying to do first and foremost? What we have found is, first of all, for cancelling this particular contract, because it was a TT selling price, right? Now, in order to cancel this contract, you will need to buy dollars. From dollars, you will buy Swiss francs. And once you have bought the Swiss francs, you can essentially cancel the contract. Are you with me? Right? Now, I will need to take care of the second part of the transaction, which is Swiss franc to USD. Right? 1 month buying rate. So, how much is my 1 month buying rate?
$1.5160.
1.51. Yes, 1.51.
60.
51.
50. 1.5150.
Yes. Why is that so? Why is that so?
It's buying rate now.
It's a bid rate or ask rate, sir. 5150 is the bid rate.
5150 is a bid rate, yes. But when you want to convert from INR into Swiss francs, right? So we are trying to find, first of all, what is the Swiss franc to USD. So if I want to buy, I will have to buy at what rate? You normally say bid and ask, right? Hello? So bid is
Yes,
basically sell. Now remember, your quotation is Swiss franc to USD. So you are going to sell USD, am I right?
oh yes,
You are going to sell USD to buy
yes,
Swiss franc.
yes.
So you are going to sell at what rate?
1.5150.
Yes, 1.5150, because this is the rate at which you are
Selling US
selling
dollar.
USD and buying Swiss franc, right?
Yes,
Okay, all right. Now, what will be the Swiss francs spot selling rate? I need to find that. Swiss franc spot selling rate. Why am I doing this? And I'm going to convert this directly with, now I'm going to take the cross currency rate, INR and Swiss franc. Because I have found what is the applicable rate available, the two relevant rates for me, 49.9154. And then I have also found out I can essentially buy Swiss francs at 1.5150. So I will buy $1 for 49.9154, and that $1 is then in turn going to give me how much? 1.5150 Swiss franc. Are you able to understand that?
yes,
Okay. So $1 being the commonality, that gets obviously cancelled out. So effectively for 1.5150 Swiss franc, I am paying 49.9154 INR. Are you all with me?
yes, sir.
Okay. So Swiss franc spot selling rate will be how much? It will be 49.91 divided by 1.5150. Okay. We will rounding off to 4 decimal points. So how much will that work to? $3.9274. 74, am I right?
Yes, sir.
Okay. So I get 4 decimal points. Now, bank buys Swiss francs. The bank will buy Swiss francs at which rate? Under
32.
32.42.
original contract, na?
Or
He will buy under original contract, na? That will be 32 point.
42.
32.42 may they have covered themselves. What they have agreed with you in the contract is 32.400.
Okay, sir.
32.42 is their rate, Dada. It's
Yes.
not our rate. They are going to offer that rate to the
Interbank transaction.
interbank transaction. From us, they are going to take it at 32.40. Right?
Yes, sir.
And now bank is selling under cancellation. Now bank is selling. Bank is selling. Right? Under cancellation. At what rate? We have just computed that, which is 32.9474. So this difference is a loss, right? Or gain. Who will pay that? Difference will be payable by whom?
Customer.
By the customer, yes. Right? So here we don't have the name of the customer. So we will say payable by customer. So who is going to pay that difference? 32.9474, 32.40. The bank says I have to pay this 54.74 additional because of you, because to close this position, I will now need to buy from the market, and in the market when I'm buying, I am paying rupee 0.5474 extra per Swiss franc, right? So they are going to charge the customer. So what will be the total amount which will come to? So exchange difference in total rupees. How much will that turn out to? Equal to 0.5474 into, what was the size of the contract? 100,000. So 100,000. So 54,740 is what is the total loss which will have to be borne by the customer. Okay. Now here I think there is one बराबर है 32.9474 मुझे लगा वो गलती हो गया क्या नहीं it is 9474 only 35 है so this will become 4 only all right so it is 54,740 which will be the total exchange loss which will have to be borne by the customer. Okay.
So, sir, what is the importance of that interbank transaction line in question?
Which one?
Very second line. To cover bank has entered into transaction at 32.42. Is there any?
So what happens is basically, see, you have purchased so entire transaction. How do you summarize the first line basically? What is the transaction which has happened? So customer has, say for example, you are the bank. I am your customer. Okay. So I have reached out to you that I will essentially give you 100,000 Swiss francs. From my export bill, I am going to get 100,000 Swiss francs. I am going to give Swiss francs 100,000. And you are going to give me 32.40 for each Swiss franc. So in INR terms, you are going to give me how much? 32,40,000.
Yes.
Are you with me?
Yes, sir.
Now, in order to cover your position, what you have done is you have gone to the interbank and you have covered yourself with another forward contract where you are going to sell it off to somebody else at 32.42. So what you will get is 32,42,000. Are you with me?
Yes.
So 2,000 in between is what is your margin as a banker.
Yeah, but I mean, no relevance with the question asked, I suppose. My question is that any relevance with the question asked, I mean, what bank should charge to the customer? Is there any
in this particular case, you don't have that direct relevance over here. It basically only will come into picture when you have to essentially compute, okay, what will be the incremental profit or loss you are going to make over and above what you are going to do the external party. But I am not the banker. You are doing calculation for whom? For the customer. Right? Okay. So that is the reason it does not come into the picture at all.
Okay.
So original transaction is 32.40 mein kharida and 32.42 mein becha. I have purchased it for 32.40, sold it for 32.42, thereby making a 2 paisa profit on each Swiss franc which I have purchased and sold.
Yes. Okay.
Right. So that is my margin as a banker. Now, because you have made me cancel it, so that is the reason now here I am going to make a margin. And because now I am buying it from the market at 49.4455, 49.8655. So on that, obviously my margin also has to get covered. So I'm not going to sacrifice my margin. Itna mehnat kiya for what? I also need to make money on it. So I am going to add my margin on it, and this becomes my profit. Right? Are you with me?
Yes, sir. Thank you.
Okay. All right. We have, I repeat once again, on 4th December, we have covered all the 9 situations which we have discussed over here. Right? We have solved at least one question on each of the situations. And in the examination from this module, if I were a student, I would expect this particular module will have at least one question. And going by the history, they generally do ask questions on this particular module. And predominantly, if you will find, either it is the question which we solved previously, where you have three options: no hedge, future, forward, and compare the same, or you will have on one of the forward exchange contract position, right? Because delivering on maturity, though, it will be very, very simple. Obviously, at this particular level, that may come as one of the options, where you may have 4 or 5 options and you are asked to calculate, okay, what will happen if it is delivered on maturity. So then that is just a one-line item, a one-mark question, right? But otherwise, you will have a cancellation happening or an extension, which will by itself have other charges also being levied. So you need to please prepare this, because this particular module will have this particular question being tested upon, right? And I would generally, as I said, if I am setting the paper, I would always have one question on forward exchange and risk management by default. All right. We have one more question which I would like to solve. Question number 6, which is about to borrow or to accept offer from a foreign branch, right? So I have that interest. So before I start, I have to talk about two aspects to it. Generally, like we have Forex, which we have seen, there are two-way quotes. Interest also has two-way quotes. What do they signify? Say, for example, it says 10%, 12%. What does this signify? What does this signify? If the bank is charging interest 10%, 12%, what does this signify? What is the meaning of this? It means if you are going to invest with the bank, you will get 10%. But if you are going to borrow from the bank, then you will have to pay 12%, right? So that is the meaning of 10%, 12%, a two-way quote being presented by the bank as well, right? Another aspect of interest, just 1 minute. Another aspect of interest is essentially going to come up when I have the case of comparison of my interest benefit either being provided to me by the banker, or when I'm comparing that with the one which is provided by my supplier, which we did in the leading and lagging question. Remember? Question number 2, which we solved yesterday, leading and lagging, that particular aspect gets covered. Now, a similar situation is going to be there on interest, where we are going to compare over here whether should I borrow from my bank or whether should I borrow from the offer from the foreign branch, right? So how would that particular situation work? Let's see. I'm going to take the question over here again. Question number 6. For those of you who have taken the print or have a copy of it, question number 6 is what we are going to solve. Just 1 minute, please. I will put it into. And All right. Now, is it visible to everyone? I think all the information is duly captured. Yes. All right. Let's start. Messrs. Daksh Limited is planning to import multi-purpose machine from USA at a cost of $15,000. The company can avail loans at 19% interest per annum with quarterly risks, with which it can import the machine. However, there is an offer from New York branch of an Indian-based bank extending credit of 180 days at 2% per annum against opening of an irrevocable letter of credit. Other information: spot rate is $1 is equal to 75. 180 days forward rate is $1 equal to 77. Commission charges for letter of credit at 2% per 12 months. Justify why the offer from foreign branch should be accepted. Based on the present market condition, company is not interested to take the risk of currency fluctuations and wanted to hedge with an additional expenses of 30,000. If so, what is your advice to the company? Assume 360 days in a year. All right. So, first things first. As the question itself says, justify why the offer from the foreign branch should be accepted. So, we need to first of all do the comparison. What is the comparison we are going to do? I have an option of either taking a loan at 19% per annum, or the other option is taking an offer from the New York branch of an Indian-based bank. So I will need to do the comparison of these two aspects. Let us start. Okay, first, what is my option 1? Option 1. What is my option 1? Loan at 19% per annum. Am I right? With quarterly risk. All right. So what is the cost of equipment for me? Yes, what is the cost of equipment for me?
15,000 USD into 75 spot rate.
Yes, 15,000 into 75, which is the spot rate. So the amount turns out to be, I have 11,25,000 rupees. All right. On this, I will have to pay interest, right? Now I can do the interest computation over here. How do I do the interest computation over here? Remember, it is quarterly risk. This is the option. It says it is 19% annum with quarterly risk, meaning it is going to have compounding factor coming in. And compounding is going to happen on what frequency? On quarterly frequency. Right? So what will be the total interest which will be charged to you? What will be the total interest which will be charged to you? Yes. 11,25,000. 11,25,000 into. How do you do the computation? By the way, this period is how much is the period? When do I need to pay? Comparison is 180 days over here, as you can see. Nowhere else earlier it is written when I'm supposed to pay. But it says clearly this is a 180 days option, which means obviously I have to make the payment within 180 days. Okay. So that is a 2-month period basically. So I have to pay over here 19% per annum. So my quarterly interest rate will be how much? 1 plus 19% divided by 4, right? That is the 4 quarters. Raised to
4.
Should I do raised to 4 or raised to 2? I have to calculate interest for how many days?
180 days. Okay, the
180
rest.
days. So raised to 2, right? However, in this calculation, there is one challenge which is going to happen. And what is that challenge? What is that challenge? You can see over here, I have already added the principal also over here. Right? I have added the
Yes.
principal over here. So I will need to subtract that.
Yes.
I want only the interest component. Of course, if you want with the something went wrong. What was it? 19% divided by 4.
So should it be 4 or 2 there?
No, it will be 4 because it is quarterly rest, right? So compounding will
Yeah.
happen on a quarterly basis. One zero nine four one three. Okay. Now, those of you who are not very good with mathematics, अगर आपको लग रहा है थोड़ा challenging है, तो हम क्या कर सकते हैं यहाँ पे? We can calculate it for. आप देख सकते हैं यहाँ पे मैं क्या कर रहा हूँ? 11,25,000 into I am going to charge 19%, right? Divide by 4, because otherwise you can say into 3 divided by 12. This is for 1 quarter. Am I right? This is for 1 quarter.
Yes.
So I'll get how much? I'll have 53 for 37.50 for the first quarter. Now, since this is a compounding rate, so I will need to replicate the same process again, right? Here, what have I done? What did I do over here? I've calculated the interest over here. Now I will need to calculate on the principal plus interest, right? So I am going to calculate again on 1125 plus interest, and on this you will calculate 19% into 3 upon 12. You can see these are 2 quarters, right? Total interest कितना आ रहा है? 109,413.28. So whether you want to do it this way, quarterly interest computation, you can do that also. If you want to do it mathematically like this, that is also okay, right? So total outflow will be how much for the client? Total outflow for the first option in that case will be 1125 plus interest. So I'll have total outflow of 1234,413. This happens in my first option. Are you all with me? So far, so good?
Yes.
Shall I start with option 2 now? What is my option 2? Taking the offer from the foreign branch of the Indian bank. Because I am, remember, purchasing this equipment from a USA, right? So I have another branch of the New York branch of the Indian bank, which is willing to offer me this particular option. So I have to pay cost of LC, right, at 1%. So how will I do that? What will be my calculation over here? I have to pay $15,000, right? $15,000 into 75, because that is the total value, into 1%. So amount wise it turns up to be 11,250. This is the cost of LC, because you are told over here, however, there is an offer from New York branch of an Indian bank based extending credit of 180 days at 2% per annum against opening of an irrevocable letter of credit. So why did I charge over here 2%? This is 2% divided by
2.
into 180 divided by 360. I hope this is understandable to everybody. Right? So 2% for the per annum hai. So for 180 days, it is half. That is the reason I have calculated over here cost of LC at 1%. Further, what you are told is commission charges for LC is 2% per 12 months. Spot rate, 180 days forward rate is given to us. Right? And yeah. Now I need to add interest. Interest for how many days? For 180 days. So interest for 180 days is going to be I am going to pay 19% interest into 180 divided by 360. मैं क्या कर रहा हूँ? कौन सा इंटरेस्ट कैलकुलेट कर रहा हूँ?
सर ये तो इंडियन देश है, इंडियन रेट क्या है?
Yes. So why am I applying this? I am taking this 19% interest on which one? There is a cost associated because I have to put a certain amount of money upfront. And what is that money? This money. I have to pay this upfront, right? 11,250. So this 11,250 is to be paid by me upfront. Now, obviously, I don't want to pay anything from my pocket. So indirectly, what is meaning is I am essentially borrowing this. Now, say for example, one of you says, "Sir, I have 11,250. Why will I borrow money?" Fair enough. But in that case, we are accounting for this 19% as an opportunity cost then. Right? So we add this interest part for laying out this 11,250 over here. This was something which was done earlier also, if you recall, in the previous questions also, where we were essentially laying out initial margin. You see over here, where we had paid initial margin, 560 to 500. We had accounted for cost on that as well, interest cost. Right? The same way, here, when I am accounting for paying 11,250 earlier, because I have to pay that upfront to get the LC. So I will account for interest for 180 days. Now you might have observed one change over here, and that one change is, if you see, I have calculated 19% interest on a non-compounding basis. I am not compounding this interest. Have you noticed that? Earlier, over here,
Why is it so, sir?
we have compounded over here.
Why, sir?
Compounded. Why? Because earlier, I was specifically told this is at quarterly risk. This is 19% interest per annum with quarterly risk. So specifically, I was told what was the quarterly compounding is supposed to be there. Are you with me? Here, for LC purposes, when I am taking the loan, it is a specific 180-day document, right? So that is the reason here quarterly compounding will not apply over here. Are you with me?
Yes, sir.
Very important to note this particular aspect because that is a differentiating factor. And in the examination, say for example, if you find it difficult to remember this, etc., then remember you are, say for example, you have taken 19% compounding over here as well. मैंने पहले ही किया, इधर भी कर देता हूँ. ऐसे नहीं हो सकता कि there is a difference between this and that. If you are from that school of thought, mind you are still erring on the higher side. So how do you protect yourself? In that case, you will write an assumption. It is assumed that 19% per annum interest is quarterly compounding for applicable for even when you take LC. Try to cover yourself with that assumption. Logically speaking, because it is not specifically mentioned, so I would like to take the benefit as a chartered. I would like to take the benefit and reduce my cost. Right? However, if you feel the other way around, ensure that for examination purpose, you cover yourself with an assumption. That's the hedging that you need to do. Make sense?
Yes.
Okay. Now, what will be the payment that you will have to do? Payment at the end of 180 days. So, what is the payment you will need to do over here? Obviously, I have my USD obligation. So, I have to pay for equipment. Equipment cost is 15,000. This is in USD. So, I'm going to write over here USD. Okay. Add interest. Interest at 2% per annum. So, that will be how much? 15,000 into 2% into 180 divided by 360. This is the interest rate at which I'm going to get the equipment. Am I right? So my cost now becomes how much? 15,000 plus 150. Now I need to convert that to conversion cost at, because you have not taken any forwards or futures over here. So obviously we'll have to convert at spot rate after 180 days, which is
77.
77. Right? So 150 into 77. We get 1166 by 50. Now, what will be my total cost? What is the total cost I'm going to have? Total cost. Yes. I will have this A and I will have to pay for the
B. A plus B.
Right? So I will have total cost will be A plus B, which is 318 plus 1178, 868. Now you can compare 1234, 1178. Have you been able to justify? Because that is what was asked to us. Have you been able to justify? Option 2 is cheaper than option 1. Thus, justified. Right? Okay?
Yes, sir.
All right. Now, second part. Based on the present market condition, companies not interested to take the risk of currency fluctuations and wanted to hedge with an additional expense of 30,000. If so, what is your advice to the company? Yes. What is your advice to the company? What should we do? So think of it first of all, $15,000. You want to spend up to 30,000. So 30,000 divided by 15,000. So per dollar, what is the amount? Per dollar, what is the amount? 2 rupees. Am I right? 30,000 upon 15,000 will be 2 rupees per dollar, which you are willing to spend for getting the hedge. Yes or no? So
Yes.
if you are going to spend, say for example, if you are going to spend 30,000 on getting, say for example, this forward contract rate, right, 1 equal to 77, then in that case, you will get 2 rupees more on the forward contract and you will end up spending 30,000. So effectively what you will be left with is $75. Are you with me?
This part is not clear, sir.
Okay. So if you are going to take a hedge, you are going to purchase a forward contract. What is the spot rate today? Spot rate today is 75, right?
75.
So I want to cover my exposure, right? And I want to cover my exposure that tomorrow, because it's a payable, remember, I have to make the payment. So if this is going to become 77 rupees, the challenge is I will have to pay 2 rupees extra. So what I am willing to do is I want to essentially cover my position. And I am willing to pay 30,000 extra to cover my position. So what happens as a result of that? Yes, what happens as a result of that? I will end up spending 30,000. Will you get 30,000 more? Yes. Hello.
Yes, sir.
You are basically having a difference of 2 rupees per
Yes.
dollar, right?
Yes, sir.
What is the question? Based on the present market condition, company is not interested to take the risk of currency fluctuation and wanted to hedge with an additional expense of 30,000. If so, what is your advice to the company? So if they are going to hedge at 30,000 rupees extra expense, meaning they are willing to spend 2 rupees extra in order to ensure that my risk remains at 75. So I can essentially get a cover at 77, which will pay me 2 rupees more, right, in future. And
Yes,
that
sir.
2 rupees will be eaten away in the expense which I am doing, because this cover is not going to come free. So effectively what it works is, for my $15,000, my forward contract will pay me 77 rupees, out of which I am going to, I have already spent 2 rupees to procure this particular forward contract. So what will be left is 75. That is what I will need to pay. Oh, sorry. This is a payable. This is a payable, one challenge. So in that case, wait. It will become actually, what will happen if I take a cover? It's not a receivable. Sorry, my mistake. Right? It is a payable. So what happens? I have a forward contract where I will, so I will buy $1 at 77, right? Plus incrementally what is happening is, compared to the spot rate, I will have to pay 2 rupees more. Even if I take a forward contract, I will have to pay 30,000 more. Are you with me? Plus I am paying 30,000. So effectively, it still leads to 60,000. So either ways, 30,000 का outflow तो होने वाला है. If you are going to go by the spot rate, you will essentially pay only 30,000. But even if you secure yourself with a forward contract where you are paying 30,000 expense, even then you will have an additional 30,000 का outflow. ठीक है? Is that clear to everyone?
So, sir, what would be advice? What should we write? I mean, it's asked, no, in question.
Yeah. So you will have over here, is not interested to take the risk of currency fluctuation. So they want to hedge their risk by spending 30,000. So any which ways, first of all, they will spend 30,000, which is this expense over here, right? So they spend this 30,000, plus they will still have to spend another 30,000. Why? Because the moment you cover yourself at 77, 30,000 आपका expense तो गया ही, plus for procuring this particular product, but also for forward, you will have to pay 2 rupees more. So your total expense in that case will be 60,000 if you want no risk at all. First to buy this forward contract, and then under the forward contract, you will have to pay at 77. So cost of the forward contract and the differential variation part, right? Spot rate is 75. You are going to buy it at 77. So 2 rupees extra. So total 30 plus 30, 60,000 is what you are going to pay extra. So after paying 30,000 also, you will have an incremental outflow of another 30,000. Are you all with me?
Yes, sir.
So आपका total cost in that case क्या हो जाएगा? 11,25,000 which you are going to have in the spot plus 60,000. So 11,85,000 will be your total cost. Okay. And remember again, in that the assumption is that you are not taking any loans. Because if you were to take this loans, etc., then this 60,000 is an overall incremental in option 1 or option 2 respectively.
Yes.
Okay. All right. So what we have covered today is we have covered the different approaches for foreign exchange and risk management. We mentioned at the start, no hedging is an option available, though it is not a risk management technique, but it is an option available. Invoicing in local currency, where you put the onus and risk on the customer, not a very sustainable or a good option as such, but that is one of the options, because while you avoid the risk of foreign exchange currency, you do end up taking a certain exposure or risk of losing a client. If somebody else provides that convenience, your client may choose to leave you, right? So it is a business risk in that case, but not a foreign currency risk in that case. Forward exchange contract, where you essentially buy a contract from the bank, we discussed that. Netting and money market hedge, if you have an asset and a liability in foreign currency, then you can essentially ask your client, please pay towards my liability. You can do the netting. In that case, I don't need to take for any exposure. But where the dates are not matching, then we can use money market hedge to create that good, happy coincidence so that my liability and asset can be matched. Then leading and lagging, whether you want to pay early or later, that depends on, we discussed that also, whether my currency is appreciating or depreciating, right? We discussed that over here earlier. All the 4 options, right? So we discussed all the 4 options over here. Thereafter, we also discussed the forward through hedging through forward currency or options. You have learned that in your derivatives, so we have obviously not discussed that in detail over here because that you learn in your derivatives module. However, we have covered a couple of questions where we discussed the 3 options, wherein we discussed what happens between forward contract, futures, and no hedge position, right? And as I mentioned over here, I would still recommend in the examination also try to prioritize what is a low-lying fruit for you. So as I calculated over here, first I calculated using forward contract, then no hedging, because those are very low-lying fruits. You will easily be able to secure your 2 marks easily, 1 each, right? And then you focus on the longer part. But again, that is a paper writing strategy which you may choose. And then we discussed about the different ways of termination of a contract. Maybe delivery, cancellation or extension, or early, on maturity or late. I would recommend that you please go through the sessions which we had done earlier on 4th of December, where we had solved 1 question on almost each of those options, which will give you a good idea and also comparative understanding of how the things change. With that, it brings us to the conclusion of this session. Any further doubts, queries? Yes, any doubts, any queries?
Sir, I enjoyed the lecture. I mean, this is a complex subject actually.
Thank you very much. It's
Abrakesh.
Abrakesh. Thank you, Abrakesh, for your participation, active participation, in fact. And also, I think one madam was there, was actively participating. What's her name, beta? I think she has already left. Was it Shweta?
Shwetam, yes.
All right. So thank you, everyone. Shweta, Sita, Prashant, Resham,
Thank you, sir.
Saminath, Mukesh. Thank you very much. Ashok ji, we are done, sir. Thank you very much, sir.
Thank you, Ashok ji. Have a nice day.